For a lot of people, the thought of investing for the first time is terrifying. After all, it seems like a complicated world with a lot of technical jargon and acronyms thrown around, gate-kept by men in three-piece suits. But investing in the stock market doesn't have to be complicated or scary. You can learn how to build an investment portfolio that perfectly fits your life and your financial situation. You can manage your own investments with confidence, and you can be your own financial advisor. Over the next 10-ish minutes, I'm going to teach you exactly how to do that. I'm Britt, your favorite YouTube money coach, and I've taught thousands of women who didn't think they would ever be able to invest how to successfully build wealth through the stock market. And today I'm going to teach you how you can too in 8 easy steps. The first step is to build a solid financial foundation. Now, if you've been around before, you've heard us say this in these videos, but I'm gonna give you an analogy. You know how in college there are some classes that you can't take until you've completed the prereqs? Prerequisites create a solid foundation of knowledge so you can ace the harder classes. And there are certain prereqs you need to complete before you can start investing so that you can successfully build wealth. And here at Dow Jones University, we've created our own catalog of everything you need to complete before you start investing. We call it our wealth building roadmap. Let me break it down for you. First, you want to spend less than you make every month. This is the foundation of financial wellness. If you're spending more than you make, then you'll never get ahead financially. Second is to pay off high interest rate debt. This is any debt with an interest rate above 7%. On average, stocks have an interest rate of 8 to 10%. So if you have debt with an interest rate above that, like credit card debt with a 20 or 30% interest rate, you'll never be able to actually make money on your investments because you'll always owe more than you make. So pay off that debt first. Third is build an emergency fund. This is to financially protect yourself in the event of an emergency. You do not want to have to pull your money from your investments and potentially lose money if your car breaks down or you get laid off. So if you don't have an emergency fund, you can start by saving just $1,000 and then build up until you have enough to cover 3 to 6 months of expenses depending on your risk tolerance. Fourth step is to save for retirement. Saving for retirement is all about building up your savings so that once you stop earning income, you still have money to live off of. In this step, you want to max out your retirement accounts and put money away for future you. If you want to learn more about the wealth building roadmap, we have a full video on it, which I'll link to in the description. So once you finish those 4 steps of the roadmap, you are ready to invest. And then we get to the next step. Step 2, once you're ready to invest, is choosing how you want to invest. So these days, investing is more widely available now than ever before, and you have more options for investing than any other time in history. Sometimes options are good, sometimes options are overwhelming. So I'm gonna break them down for you. The 3 broad categories you have when it comes to choosing how to invest are these. 1, you can hire a professional. This is when you hire someone like a financial advisor to manage your investments for you. It's the most hands-off option, and it's also the most expensive option. Having a financial advisor manage your money can cost you hundreds of thousands of dollars over your lifetime in lost returns and lost fees, and they often aren't going to do a better job than you could by just investing in index funds, which we'll talk about later. Also, most financial advisors won't work with you unless you have at least $100,000 ready to invest. So suit yourself, but this is definitely not the option I would recommend. 2 is robo-advisors. So a robo-advisor is a digital platform that provides automated, algorithm-driven financial planning and investment services with little to no human supervision. When you invest with a robo-advisor, you make a few decisions up front, like you share your age, your risk tolerance, what you want to invest in, and the robot invests your money for you in exchange for a fee, which is usually about 0.25% of your assets. So if you're investing $1,000, that's gonna cost you $2.50 per year. 2 things to note. If the robo-advisor charges you a flat fee instead of a percentage, do the math. For example, if they charge you $5 per month, which sounds like not that much, but you're only investing $1,000 a year, then you're paying a 6% fee, which is outrageous. And there are plenty of companies out there that offer this exact same service for a fee of 0.25%. So shop around and compare the fees before you choose where you're going to invest. The upside of using a robo-advisor is you don't need to manage your investments yourself, and it's a pretty simple startup process. So it's an easy way to get started. The downside of using a robo-advisor is that you don't have much control over how your money is being invested. So if you care about not investing in fossil fuels or tobacco companies, you may not be able to control for this depending on the robo-advisor you choose. Third, self-manage or DIY. As the name implies, this is when you manage your investments yourself. This may sound daunting, but it's not as difficult as it seems. This is what we teach our members to do in the $1 Million Year. So why do we do this if robo-advisors are so prevalent and so simple? Because when you know how to manage your money yourself, you get full control over your investments. And we've seen how that when women know how to manage their own investments, their confidence skyrockets. So that's what this video is about, is teaching you how to manage your own investments so that you don't have to pay any fees to advisors or robots, and you get to build your own portfolio, and you get the confidence of knowing that you can do it on your own. All right, so if you're ready to invest on your own, here are the steps that you take. The first step is to open an investment account. So when you open an investment account, you're looking to open it at a brokerage, which is a little bit different from a bank. It means it allows you to invest. And so as you're choosing a brokerage, here are a few things to keep in mind. One, good customer service. If you're having trouble with your account, you want to be able to get a hold of someone who can help you fast. So look for a place where you can call in or chat who has good customer service. Second is low fees. So there's a couple different types of fees. There's either management fees on the account or expense ratios. Expense ratios are the fees that you're going to pay to get an investment. And you want to avoid paying more than 0.3% in fees for the funds you're investing in. Often that percentage is going to be even lower, like 0.08%. So pay attention to those expense ratios. If they're closer to like 0.5, 0.6, probably want to avoid those types of investment. Third, look for a brokerage with an easy interface. The website should be easy to navigate and find what you need. If you're investing in the US, some popular brokerages include Vanguard, Fidelity, Charles Schwab, E-Trade, and TD Ameritrade. If you're located in Canada, you can open an account with Questrade or Vanguard Canada. In fact, I made a step-by-step video on how to invest in Vanguard Canada, which I'll link to below. If you can't decide on a brokerage, Vanguard and TD Ameritrade are both great options. And if you want to invest in target date funds, which I'll cover in a minute, then Vanguard has the lowest fees. The fourth step is to transfer money into your new account. So once you open your brokerage account, it's time to fund the account by transferring money into it from your checking or your savings account. All you have to do is log into your new brokerage account online, search for an option to fund your account or transfer assets. At this point, you might be wondering, wait, how much should I invest? How much money should I transfer? The answer depends on your financial situation and how you plan to invest it, which I'll explain more in a minute. The short answer is that you can invest with as little as $100. You will have more options if you start with $1,000. That said, remember that the amount of money you invest isn't as important as when you start investing. The sooner you start investing, the more money you make, even if you don't invest much to start with. So invest whatever you can to begin. You can always add in more later. Fifth step is decide how much you want to invest in stocks versus bonds. The fancy investment term for this is portfolio allocation or asset allocation. It just means the percentage of stocks in your account versus the percentage of bonds. And that number should be determined by your age or your time horizon. So stocks are considered a riskier investment, but often offer higher returns, whereas bonds have a more guaranteed return, but typically lower returns. So if you're younger and you have many years to go before you retire, you'll want to invest more heavily in stocks because you have time to ride the highs and lows of the market. But as you get closer to retirement age, you want a higher percentage of bonds to give your investment portfolio more stability. To make it super simple, if you're investing for retirement, then you can use the rule of 130. Take 130 and subtract your age. That's the percentage you should invest in stocks. So if you're 30 and saving for retirement, you can put 100% of your investment in stocks. If you're 60, you could put 70% of your investments in stocks. Now, if you're investing for your kids' college education, which is money you'll need to use in about 10 years, then you may want to choose a more conservative allocation like 70% stocks and 30% bonds. And if you're only investing for 5 to 7 years, you may opt for an even more conservative portfolio like 65% stocks, 35% bonds. Now, if you're investing for less than 5 years, don't invest in stocks. Instead, keep your savings in a high yield savings account or in bonds. 6, this step is to choose your investments. So now that you've decided your target portfolio allocation, meaning the percentage of stocks and the percentage of bonds, it's time to actually build that out. So this may surprise you, not if you've been around for long, but I don't recommend investing in single stocks, because when you put your money into a single stock, you're tying all of your money into the success of that company. Instead, you can invest using target date funds or index funds or ETFs. Target date funds are pre-formed funds with a mix of stocks and bonds that is based on your age and automatically changes over time. This is the easiest way to get the percentage that you want, and you can truly set it and forget it until retirement age. The only downside of this is that you don't have much control over what you're invested in with this option. The other option is to invest in ETFs, which give you more control over your investments, but you do need to take the time to select the ETFs that you want to invest in. So because target date funds and ETFs are both bundles of different stocks, they aren't as risky as choosing single stocks. If you choose to invest in a target date fund, all you have to do is Google target date fund and the year you expect to retire. So if you're planning to retire in 2050, you'd type in target date 2050 and let Google work its magic. Just find a fund that doesn't charge more than 0.15% in fees. Then make your investment and rest easy knowing that the funds will allocate your investment accordingly as you get closer to retirement. The other option is to create a portfolio based on diverse ETFs. For example, let's say you have $1,000 to invest. You want to create your portfolio based on 80% stock, 20% bonds. In that case, you might put $800 into a total stock market ETF like VTI and $200 into a total bond ETF like BND. There you go. There's your portfolio. You've created it yourself. If you want to learn more about how to pick and buy the perfect ETF for you, I made a full video on how to do that, which I'll link to in the description. Step 7. Now it's time for the easy part. You actually click the buttons and invest your money. I've made multiple step-by-step videos on how to invest on various platforms, so click the links in the description below based on what you're looking for. I also made a step-by-step video on how to buy ETFs, which I'll link to below if you want to watch that. Final step, step number 8, is to manage your investments. So managing investments is pretty easy. Here are my best tips for managing your investments. 1, like we've talked about, buy and hold. Plan to hold your investments for at least 5 years, ideally more. Don't check your investments too often. The stock market is a roller coaster, and you don't want to be tempted to sell when the market is low or get overwhelmed by seeing the value drop. So I don't recommend checking on your investments more than once a quarter. Then the best way to be a successful investor is to continue to be putting more money into investing. You can set up auto investing, so this happens automatically each month. And then at the end of the year, you want to rebalance your portfolio. So if you decided to do ETFs instead of a target date fund, then you'll use the rule of 130 to make sure that you still have the ideal percentage of stocks and bonds based on your age. If it's off a little bit, then you'll buy or sell as necessary to get back to that target percentage. Like I mentioned before, if you want to learn more about how to make money from your investments, be sure to check out our free masterclass, Think Like an Investor. In it, Lorianne and I will give you the need-to-know secrets of winning investment strategies and how to avoid the investment mistake that cost Lorianne $15,000. I'll leave a link in the description below if you want to check it out. Above all, remember that the most important thing is to just start as early as possible. So if you need to, hit rewind and follow every step so that you can start building a life of financial security and abundance today. Thanks so much for watching. I'll see you next time.